The Hedgeless Horseman here again for a third time on July 10, 2023. I might as well do a few videos now that I'm on a roll, and I'll be leaving for Canada on Saturday, so I don't think I'll be making too many videos in the coming couple of weeks. So yeah, might as well create a few when I can. So this video will simply be a refresher, kinda just going in or going over the two main types of opportunities there are in these cyclical sectors, or especially sentiment driven and cyclical sectors, and how they kind of intermingle with each other, and how the opportunity cost and opportunities change depending on where we are in the sentiment cycle and all that, and these are the only two things I think you really need to be aware of. I mean, it is literally not much harder than what I'm about to say, even though, yes, if you, it's like, you know, degrees of a winner. I mean, like every NBA player obviously is good. I mean, top 0.1% of basketball players in the world, but there's still a big difference between the worst basket player and the Michael Jordan. And like I said before, I mean, you don't need to be, you shouldn't seek perfection. I think that's a fool's errand. But if you just have a firm grasp of the two ways to make money, kinda, in this sector, I think you'll, as long as you get it, you'll be able to make money in potentially any sector, really. But commodity sectors especially. So the first type of opportunity is simply the beta opportunity, the cyclicality of human psychology, or the cyclicality of flow of funds. And this is kind of, I mean, this is the absolutely lowest risk, highest probability way of making money, and that's simply to play the beta angle. You know that when everybody's in, when valuations are stretched, when shitcoins sell for 5 times what they are worth, and have no real chance of actually finding something real or becoming something real, etc., but they are traded like they have a, good shot of actually becoming a legit company, then it's time to sell, because there's only negative surprises ahead for the average junior. And when everything is super cheap, when almost everybody that is willing to sell at any price has sold, then the risks are to the upside. And this will happen forever, absolutely forever. So if there's one time you could, I mean, you could play the beta angle quite often, actually. I mean, like I've shown before, if you just draw a line, something like this, in a trading sardine like Bear Creek Mining, it's like if you just bought for however long it was below this line, you would end up making at least 100% within 2 years. That's a superb return. So that's one way to go about it. Just knowing that this sector will forever act like, playing Pong. Up, overvalued, too many buyers. When everybody's in, nobody left to bid prices higher. There's no money on the sidelines. All that is left is for people to sell. Then it's gonna keel over sooner or later, and that's gonna gather momentum, which will get people to freak out and sell, and then people will sell because, the longer the downtrend persists, the more reasons people will find to sell, and the longer it persists to the upside, the more reasons people will get to buy, because I mean you can never buy too high because it could always go higher, and you can never sell too low because it can always go lower. That's the last kind of excuses you'll find at tops and bottoms, meaning that, hey, I don't care what the valuation is, I've seen evidence of this just going higher and higher or lower and lower, so I'm gonna follow the trend, which everybody seems to be talking about. And obviously you also heard, don't catch falling knives and all of that, which personally I don't. I personally I don't care at all about fixed rules like that. I mean, I was gonna say, almost goes without saying, if everybody thinks the same, how can there be an opportunity? But if you go against what everybody thinks or feels, there's where the opportunities are. So yeah, this is kind of the sure thing. I mean, I wouldn't mind. I mean, I have some friends who are dabbling in miners, and they some of them almost only have beta plays, meaning proven resources, millions of ounces on the books, etc. I have no problem with that. We're here right now using Bear Creek as a proxy. So the big move, the big change in sentiment and price for the sector is to the upside. If they have gold, silver, etc. So if there's any time one would be in boring trading sardines or basically mature developers, etc. These extremes would be the time to get in, because this is the upside risk, this is the downside risk, and of course these are all paper. For a trading sardines, every gain or paper loss is paper loss, because when you made money on paper in these trading sardines, they never stay there. They will crash 80-90%. But they will not crash forever. So after the sector, the beta plays that are still around have gone down 80-90%, they will go up several hundreds of percent. So timing obviously becomes a factor. Meaning if you're sitting at a fat profit here, that's going to get taken away. If you're sitting at a fat loss here, that's going to get erased sooner or later. Obviously you would want to buy low, ride it to the highs, and then sell out when the risks are to the downside, when there's this amount of risk to the downside and this amount of risk to the upside. So it's a very poor risk reward up here, especially at extremes like this. When this extreme finally keeled over, it was a 96% downside. And with dilution in a trading sardine, you see it's a downsloping trend line, so it's never even gotten back to this high here yet. So this is kind of the sure thing. This is to bet that humans will or that this sector will be forever cyclical. That's not a high risk bet. That's the lowest risk bet there is, because it is a cyclical sector. And it's going to be a forever cyclical sector. And it's all main reason why it is cyclical is because humans never change. You will see the ping pong of markets until the end of markets, or until we all become cyborgs. So right now this is hands down the low risk bet. This is going to change. This is going to go, I don't know Bear Creek specifically, but if we assume this is a proxy for the sentiment of the sector, we're gonna get up here sooner or later. And if that takes months or years, doesn't really matter, because the returns will be so obscene that I mean, how long would you be willing to wait for 400-500% return? That would be many years, and you would still beat almost everyone in the market if you could wait that long. The problem is, like you heard a bunch of smart people say, obviously, is that it's mainly the lack of patience that is the killer. Knowing that this is cheap, but not holding out until it's not cheap. starting to believe that this is never going to go higher is what kills people, and starting to believe that this will always go higher is what kills people here. It's like Jesse Livermore, or whatever his name is, the legendary trader, who said that. Oh, what did he say? He said it's not. What did he say? Well, something about along the lines of it's my sitting still that has made me the big bucks, and there's quotes like, you know, it's quite easy to be right or wrong. I mean, if you know that this is cheap and you buy, you're right. But if you can't sit it out and have the patience for this to become expensive, it doesn't matter if you were right when you bought it. You made a mistake later on. So this is the beta. This is the, yeah, you can take this to the bank. This sector never stays cheap, extremely cheap forever, never stays extremely overvalued forever. And the big opportunities are when we go from extreme in one side, because the next move will be extreme, and when we're extreme on the downside, the next move higher will be extreme. So the risks are the next big move is going to be to the upside in this sector, by definition. That's just how it is. So if, again, I think I could pick like 10-20 beta plays, juniors with resources in the ground, mature juniors, preferably with good management and some money, and I could go away for, I don't know, 2 years, put in a sell order at 200-300% higher, and I'm almost certain I would make a lot of money just doing that. Literally do no trading at all. Or if Bear Creek Mining is still around, that just said, hey, sell my, liquidate my entire portfolio when we, you know, get up here or something. Super easy to do, not easy to do in practice, because nobody almost can wait. I mean, people feel like, and that goes for myself as well, when you read about a company and it's like, oh, they have a potential major catalyst a year from now. It's like a year, that's like an eternity. That's how it feels. But if said catalyst, if you know that's gonna, you know, probably make the stock go up 100-200% or whatever, it's like beyond worth it, absolutely beyond worth it. But that's the thing, and I know that is a weakness of mine. I'm more patient, I would say, than 95% of people in mining investing. Well, maybe not actually, but I'm more patient than most, because you can be maybe extremely patient but a really poor stock picker, and that's probably not good. Or you can buy here and be patient, but that doesn't really, I mean, then you start off with a pretty bad setup, so it doesn't matter if you're patient. Or yeah, you buy here and you're patient, but you're waiting for the wrong the wrong move. Here you should not be patient, here you should be impatient, because the next big move is down. Here you should be patient because the next big move is up. So if you just understand this chart and you can take to the bank that this sector will forever go like this. Again, I'm not saying Bear Creek will do this, but Bear Creek is one of the best examples, because so far it's survived as a trading sardine. That's just how it is. So this is the layup. This is why it's like, do I need to check my portfolio every day? Absolutely not. Are we up here yet? No, we're down here. You know, might take, I mean, even the quickest rallies take months. I mean, this was almost just a rocket ride higher, but that's still January 1st. That's still 6-7 months. And this is, you know, one of the most, this is, I think, the best quarterly rally in miners ever. And that still took 6 to 7 months to go from one extreme to a high point. So think about that. It's like, why would I need to check my portfolio every day? Why would I need to check the stocks every day? Even in, you know, or especially in alpha plays, when it's the actual news that is the main determinant. It's not the sentiment swing per se you're playing at that point. It's the news, the value creation. So it makes absolutely no sense. It's like I'm not going to be worried at all that I'm going to be in Canada in a week. It's like why does that matter? Do I think my entire portfolio is going to be undervalued before I get back and I would need to sell? No, unless it goes up like 200-300%. So this is just absolute no-brainer. I don't. Like I said, I know it's gonna happen. That's why I know I'm going to win. I know, because that's how that this always works. Because it's forever cyclical. This will always work. Always work. And the people who forget that, which is like 95% of people, that's why they get killed. They think every move, they think here it's not going to be cyclical anymore, here it's not going to be cyclical anymore. I mean, you see it all the time. People give up on miners. They're never going to go up. That's what people say at every bottom. And that they're never going to go down, and this time's different is what they say at every top. So everybody forgets the most blatant truth there's ever been in a cyclical sector, that it's cyclical. They forget it. People literally believe. I mean, this is the funny thing about human psychology and investing. We forget, or choose to forget, the most obvious of truths. That there's never been, in a cyclical sector, a rally or a correction that's lasted forever. Has never happened. Probably never going to happen. That's why it's like betting against gold. Gold has been around for 5,000 years. If you bet on gold going away anytime soon, you're betting on a world first in human history, kinda, or modern civilization history at least. That's not a good bet. Betting that this will stay down here or go lower forever, one of the worst bets ever. Then you have the alpha return type or opportunity, which is company specific risk. Snowline has done well because they answered questions with the drill bit and they got good answers to those questions. This was not a guarantee. But that's how you can. That's one way to make money. I'm mostly in alpha plays nowadays, so I'm mostly betting on the management and the news flow from the actual companies. Bear Creek might not put any material news, but when this sector gets hot, you'll make money in it. And yes, sure, there's alpha plays that are going to go up as well, but they won't go up like this in a 3-year bear market unless there's some big questions being asked and good answers being returned. But this is not a sure thing. That this sector will get more expensive sometime in the future, that's a sure thing. That any company will create a lot of value and multi-bag, that is not a sure thing. Here's another alpha play, which I lost a bunch of money in. White Rock. Bad management. Didn't get good answers to the questions. And they probably asked the wrong questions, or focused on asking questions on the wrong projects and stuff like that. Big difference. And of course, what people always say is, you hear this all the time. Well, if it's gone down 90%, you're gonna need a 10-bagger to get back to even. And that's why they harp on bad picks or make fun of people if they've had a stock go down a lot. It's like, oh, look at that idiot. It's like, I mean, that's an idiotic statement. First of all, who said anything about do you need to make it back in the same stock? If you started off with $10,000 here, let's say actually, I mean, I think it's halted. I think they might be bankrupt. So let's take it to the extreme. Bankrupt, minus 10,000. If you invest, let's say 10,000 here, at $1. You did no trading. You just thought that, hey, I think Snowline can still grow. I think there's alpha to be had. You would almost have $40,000. So when people like, you know, a pick goes south and they're like, his portfolio must have destroyed his portfolio. Snowline alone would have paid for 3 similar sized positions that literally went to zero. I haven't had many companies go to zero. 50% corrections, or 60 or 70 for a while, or even 80 for a while. Yeah, that I've had. But this would pay for, Snowline alone would pay for, if you had equally sized positions and you bought here, you know, quite early, and you bought around this level, which is, I was gonna say, relatively high. Paid for 3 juniors that went to zero at same position size, or 6 that got cut in half by 50% from one stock. And this is not a 10 bagger, this is a 4 bagger, 300% return. If you get one 10 bagger, it would pay for almost 20 juniors equally sized positions that got cut in half by 50. So think about that. It's like, but now we know that most people don't even play the winners correctly, including me. I typically always sold too early. I thought that, discovery hole has been made or something like that. I better sell because I'm sitting in a 50 to 100% profit. Whereas, as I later found out after I thought about it, and I've talked about a bunch of times, the discovery hole is actually step number 1, and that's when it gets more de-risked, because it's much more likely for a junior to become a 10 bagger after the discovery hole and after the discovery pop than before. Whereas most people forever believe, because they don't think about things, I guess, enough, that they believe that, hey, okay, let's say this was a discovery hole, and then you sell here because, you made, I don't know, 50. Let's say this was a discovery hole, and this might actually have been the discovery hole. Let's say you sell immediately. Yeah, you get your 44%. You missed out on this. Or you sell even here, it's like 100%. I'm taking my profits and running. Whereas like this, and me, and I've talked about this quite a lot, or more and more lately, I would say, that I much prefer post-discovery plays. Let's say I'm comfortable having a 2% position here. Then they make a discovery hole. Then we're talking, it's like, well, now there's actually a shot that they might be onto something. It went from a sub 5% chance that they might have an actual discovery and a future deposit or future mine, to they make a discovery hole, good discovery hole, as the Kennerland study suggests, early results. If those are good, that says a lot about the potential quality and robustness of the deposit. So when this jumps 100%, and you start off with 2% and it goes up to 4%, most people, okay, I'm selling out now because my 2% has gone up 100%, so I have a profit. And especially people who are not used to having profits at all, they think that, wow, I'm so smart, I'm going to take my profits. But like, if you take immense 95% chance of failure pre-discovery, let's say, and you sell after a 100% pop, that is mathematically insane to take 95% chance of failure risk for a 100% return. makes absolutely no sense, and that's why, of course, most of us start up doing dumb shit like that. We bet when the company is extremely risky, and then we reduce our exposure when it's getting less risky. So I mean, sometimes what I did in what I did in Snowland was that I don't remember when I did it, but I guess it was around maybe $1 or actually maybe $2, whatever. I increased when I started to get convinced that the Valley had a above 50% chance of becoming actually a company making deposit. I jacked up my exposure big time, hundreds of percent. Whereas, so basically, if let's say you had no position here because you thought it was too risky, no discovery hole yet, boom, discovery hole. And some people who played, look smart. Let's say they had 10% of their portfolio in pre-discovery play here, and I'm not specifically meaning Snowland because there was a lot of promising context. But anyway, let's say they have a fat position, like 10% of their portfolio. They make 100% return on that. So the 5% chance of success happens, which is, again, mathematically stupid when you think about it, to play for 100% reward with a 95% chance of failure. So 5 out of 100 times you'll make 100%, take your money and run, and 95 out of 100 you'll get cut in half or something. You're gonna destroy your portfolio in no time. But at face value, that looks smart, and that's the interesting thing. That's what I love, which almost nobody almost gets for some reason. It's like in poker, you always have to think about making making plays that made sense, regardless of what the actual outcome was. If you're all in with aces and you know you have the best hand, and you lose 10 times in a row, that doesn't mean you should stop playing aces. That was in the long term, that's a very profitable all-in, because you're at least an 82% favorite. Or was it 88? I don't actually remember off the top of my head. But you have the best hand you can possibly have. So by default, you should play that regardless of what the actual outcome is. So it's like there's a bunch of times, for better or for worse, that it's what people say, and I think Rick Rule said it. He when he started off and he got in I think near the lows and had a big bull run, he made a lot of money. He says something about, and a lot of people have said as well, that you shouldn't confuse a bull market with brains. And same here, if you make a bad risk reward bet, if you're looking for 100% return when the chance of getting that return is just 5%, and the chance of getting that position cut in half is 95, that's an atrociously bad bet. But they can still make a discovery. Position goes up 100%, and you look smart, and you think it was a smart move, while in reality it was an absolute stupid move that you got lucky on. And what's worse than this, or let's say you have 2%, a 2% position here, it doubles to 4%, but the hole is so good, let's say, or the company is still so cheap relative to how good the hole is, that you should not only not sell, take your profits and run, you should increase the exposure from 4% after the double to maybe, I'm just making a number up here, like 12%. So not only should you not perhaps take any profits, you should actually triple or quadruple down based on the new information. So it's like you can see a chart like this, for example, but every single person will have made different decisions in this chart. And the only thing to make money over the long term, you obviously have to follow a strategy that makes sense, that you can repeat. If you take absolutely shitty bets, high exposure with extreme risk, and you get lucky once in a while, yeah, but in the long term you're gonna be absolutely buried. You're gonna annihilate your portfolio, because it is a piss poor long-term strategy to play for a 5% chance of getting 100% return, and on the risk side there's a 95% chance you get cut in half. If you play those bets an infinite amount of times, your portfolio is going to be infinitely in red. You're going to go down to as close you can to zero, and when you add actual commissions and etc., you're going to go to zero. But at face value, when it happens, it might look smart. I probably made money on bad decisions. I probably lost money on what I think are good bets. Theory comes before practice. And yeah, this ended up with a bad outcome. Was it a bad bet? I guess so. Or maybe I should have figured it out sooner, let's say. But I can't say that. I don't know if my heavy bet on Snowline was good. I think the theory behind it, which I wrote a very long piece about, I think that the theory in that for the bet, I think that was very sound. But just because I made money on Snowline doesn't mean it by definition was a good bet. The outcome doesn't necessarily say anything about how good of a buy it was, let's say. Dogecoin looked like the best bet in the world for a period of time, even though I thought it was worthless, because it was created as a meme. And of course it went down 97%. But that didn't stop people from looking really, really smart for a while. And of course there are people who are actually good at sentiment trading, and I mean that's few that are, but some are. But if you understand that, I mean, I would understand that if somebody said, yeah, I know Dogecoin is absolutely crap and worthless, but I know how people work. This has more room to run, let's say. Then they understand the risk. Then they understand the nature of the risk they're taking. But I personally can't even do stuff like that, not with a big position, because I know that time is against me. Sooner or later, Dogecoin is going to go to its intrinsic value, which is zero. And I hate just betting on greater fools. That I can't take big positions in those kinds of things. But when I think value is a lot higher, or it's like I have pretty much 100% exposure to juniors. Why? Because this is a absolute layup bet. I know they are too cheap. This sector is unsustainably cheap. It's getting cheaper by, I mean, just from the supply-demand fundamentals, it's been getting cheaper and cheaper and cheaper. And still prices have also become cheaper and cheaper and cheaper. Well, I should say value has been going up, but prices have been going down. This is not a Dogecoin situation. This is as close to a sure thing you can get. We're near an extreme low. It's going to go higher. And of course we have the, again, what's the opportunity cost of alpha? Well, that's the opportunity of beta. So when sentiment is in the crapper, and we know that, hey, ounces in the ground trade anywhere from 20 maybe down to 10 to 80, or maybe up to 150 or whatever. Very broad ranges. And we know we're going to get to a 80% per ounce environment sooner or later. And if it takes from 20 to 80, If that takes 4 years, it would be worth it. And any dry powder would have, 4x future expected return. You could wait a long time for a 300% return, for example. The market average is 8 to 9% per year. So it's an absolute no-brainer, almost regardless if we know when it's going to happen. We just know that it's probably going to happen within the next 5 years at least. I mean, I think it's going to happen a lot sooner than that. But if you know that, hey, this would be a kind of a profitable bet, even if it took 5 years. Anything sooner than that would be a bonus. Of course, the one caveat is the longer it takes, there's more risk for dilution. So that's where actual stock picking, or at least evaluating your portfolio, even if you're only in beta plays, comes in, because you don't want to be in a heavy diluter, even if you think the rally is going to start within 6 months. It might be in 2 years, and if they have diluted too much, an extreme amount, or go bankrupt, I mean, then it's a problem. But of course, the best scenarios, in my opinion, the absolute best risk rewards are the hybrid plays. There's not too many of those around, but typically those have the best risk reward, meaning that you have, let's say you have a stock that both has resources and it's trading at this level. This is the value. Here is the price. So you think it's like sooner or later, I think it's, well, that might have been a bad example. Let's take it up a notch. You think, hey, this is the value of this stock, what they already have, what this junior already has on the books. It's going to go up 165% when sentiment changes. Probably going to go up more than that if we go into real high sentiment. But like, somewhat conservatively speaking, you think, hey, there's 165% upside in this stock based on just the success they have, meaning it's a value play, margin of safety play, because it might go lower for a while, but it will sooner or later gravitate towards intrinsic value. So regardless of how the way, what way it gets there, that's what you have in your back pocket, kinda. Sometime in the future I'll make 165%. But if it has that and growth potential, then that's gonna be a margin of safety that with time just goes higher and higher. So then you get actually paid to wait as well. So the more time you give management to create more value, maybe within 2 years they might have doubled the resource. Then we're not talking from this price level today to the price level in 2 years. We're not talking 165. We might be talking 470% upside in 2 years. So the company bought at price whatever today. In 2 years, you think it's not going to be worth what it's worth today, but what they have banked on the books today. But you think what they have banked in 2 years is going to be significantly higher than what they have today. So you're buying company X at price Y today, and you think the value in 2 years is going to be up here. So this is actually the opportunity you see. If you think they can grow for 2 years and they're starting values here, even if you're wrong, you still get your 165%. That's the margin of safety. If you're right and your base case materializes, you're going to get 463% in 2 years. Or the future value to price gap today is 463% in 2 years. You're playing kind of a 3D chess. You're not thinking what it's worth really today. You're thinking what it's worth today and what you think it's going to be worth in 2 years when the news release says you expect to see have happened, because nobody is thinking about that. Absolutely nobody. And let's say it goes a bit higher, and people typically, hey, I'm up 50%, I should sell now. But the case is playing out. Then you still have a pretty good price to future value gap ahead. Sure, it's down to 277, but if you haven't found anything cheaper, that might still be the best buy, even if you're up 50%, etc., etc. So those are the hybrid plays where you have both alpha and beta. I mean, in my opinion, the best example of that I know now would be Magna Mining. They have 2 resources and exploration potential, and they're looking for acquisitions, which is I mean, akin to growth, especially the way, how cheap they were able to get Green Hill. So not only do I think Magna is very cheap based on what is already known, they could basically miss on every single exploration hole, and I think Magna is still very much undervalued today. So that's what my future returns are in the back pocket, if you know what I mean. Not that there is a guarantee. A meteor strike might hit, or who knows. I mean, yeah, you can come up with scenarios. That's why I'm not 100% in Magna. But I'm treating it based... I mean, evaluating that like I got a high probability future return of, let's say, 200%. But there's also a possibility it might grow a lot over the next 2 years. So I think the price of Magna today, in my base case scenario, it's extremely cheap relative the value of Magna in 2 years. But people have very short attention span, so they're thinking about, okay, what's been proven today, maybe the next news release. But I'm front running a bunch of news releases. So when it goes up on some news release and people pay attention because it's happened just now, it's like, oh, okay, it's up. And some might, okay, I'm taking profits, but that might be, that news release might, it's like I said before, the most valuable thing in a news release is actually not what the news release says per se, it's what it says about the next 10 news releases. That's why discovery hole is so big, because as soon as you have a good discovery hole, it suggests that there might be 2-3 years ahead of good news releases spawned from that one discovery news release. But people, and I used to do that as well, they get off the train. They don't think about the fact that, hey, yeah, it's popped now and it kind of, looks expensive because they only have one hole. But if you're thinking, well, this hole suggests that in 2 years, let's say price is here, so you jump to here, so it's at face value it's expensive because they only have one hole and whatever, maybe some resources, etc. But you think the growth curve is going to be like this. So yes, it is expensive today based on what is confirmed, but not relative to the value trajectory you believe is going to take place. I mean, again, like this, I mean, one could say that, yeah, this was expensive here because they only had a few holes. Does this price look expensive 1 year later? No. Because those discovery holes at Rogue ended up being, they were telling about things to come. So you would be up 146% if you just held on. The discovery hole was the start. That's all of a sudden it went from having no discovery and no idea of probable growth to a discovery hole. All of a sudden, hey, now this company changed from, let's say, no probable growth. Well, they have had Jupiter already, so that's not completely true, but for argument's sake, all of a sudden, pre-discovery, you don't have a growth curve. A junior without a discovery hole doesn't even have a growth curve. As soon as a discovery hole is made, then that might be the first news release of a multi-year growth curve. Anyway, thought I would touch also on some of the what appears to be liquidation in the sector, because we know, when do investors want their money? When the sector is not performed. People want to take their money out of funds at lows. That's just how it is. I didn't make the rules. God made the rules. How we work. Okay, so here you can see Sanyo Gold. Makes first discovery of gold mineralization. Well, that's a good news release, it sounds like. Continues to intersect gold. Well, that doesn't sound too bad. 11.4 grams per ton over 15 meters, including... Well, that's a great hole. Okay, let's look at price. And lo and behold, this looks like capitulation selling. This looks like a fund, because nobody can read these news releases, look at this valuation, and I think they have 2 million in cash and say, wow, that's expensive, I better get out of here. Nobody in their right mind really would do that, unless they knew that, you know, this part of Africa was going to have a war soon, and you knew that for certain pretty much. No, this is probably a fund who have investors, and the investors think this sector sucks, and they said, hey, I want to sell my shares in this fund, whatever, give me my money back. Okay, the fund has to sell shares, not because they want to or think it's a good idea to sell. It's because the poor investor who invested in that fund says, you have to give me money, so they have to raise money, so they have to sell something. I actually bought some shares at 6 cents. If it goes back to that, I'll probably buy more. We have other cases. Well, no, it's not applicable, I would say. No volume spike. Montage Gold. You can see here, for example, I mean, it's not the hugest volume spike, but like 322,000 shares all of a sudden, from like, yeah, okay, highest since this time, since 26th of April. Okay, why would somebody sell a lot of shares at the lowest price in 3 months? Okay, are these news releases bad? Nope. Upsized placement, a lot of cash. Closest bought deal. Montage intersects high grade mineralization. That sounds like good stuff. Money and high grade mineralization. But obviously there might be people in here who, you know, it's a bought deal. So if I remember correctly, I'm not even that good at stuff like this, but you can sell shares at any point in time. So maybe somebody needed some money. You can see it dip to 54 cents. That's a pretty huge candle. Nowhere can you see in the news that would make you think that, hey, A, that things have gone bad, or B, it makes a lot of sense to sell at a lot of shares at the lowest price in 3 months when nothing bad has happened, when the value of the company has not gone down. Now that looks like somebody needs money for whatever. And of course they just sold it in one fell swoop kind. I mean, the selling might not be over even. But that's typically not how you get the best price. So that suggests that somebody needed money quick. So don't underestimate how good these flash opportunities can be. Let's say again, let's say Bear Creek Mining, let's say, who knows, maybe, I was gonna say the downtrend should have ended here, but somebody had to raise money or whatever, and you see a flash crash. I mean, all of a sudden, let's say this would not have happened unless a fund was having redemptions, for example. Let's say this would be the kind of floor. We can go down here. Maybe this would have been some kind of floor without forced selling. Oh, that's a 434% opportunity. But somebody needed to sell. A fund needed to raise money. Investors were asking for the money back. Boom. All of a sudden, a 689% opportunity presented itself. Didn't last too long, then it went up 200% after that. That's how quickly opportunities can come and go. So I'm interested in anything that sees high volume selling with no bad news at a time like this, because that is not smart money selling most of the time. That's funds. I mean, if you see spikes in a lot of juniors at the same time, that's not company related. Those are funds needing to sell. And I bet the managers don't want to sell, but they have to, because otherwise they'll get sued. They have to give them the money. Cartier Resources, lo and behold, like volume spikes at the lowest price in like a year. 52-week low, somebody's like, yeah, I need to dump a bunch of shares. And you can see that it wasn't over on the first day, it's like, and it just, cratered the price. I haven't followed up that much on Cartier Resources, but shows new exploration potential. That doesn't sound bad. I don't know, maybe they will need to raise money soon and somebody's front running that. I don't know. But still, 23 million, you can see where, the levels it was when sentiment was better. Do I think Cartier Resources has lost, 75% of its value? I don't think so. Without even having gone through the news releases. I just don't think so. And when you see big volume spike at lowest prices then something should have gone bad for somebody to say like, hey, yeah, the price is down, it's 60 to 70% cheaper, now I'm gonna sell. Now if I had to guess, fund liquidation, or somebody needs money, the world is kind of going crazy. So it's like, if there was ever a time, I've actually been starting to look at peer-to-peer, like what's it called, like marketplaces where people might sell coins or stuff like that, because we know inflation is biting into people's standard of living. People's margins at home are squeezed. Electricity bills might have gone up. The rents have gone up. The food prices have gone up. The interest on their mortgages have gone up. People need to sell to raise money. The same goes for stocks. You would rather sell a stock at 52-week lows than to have your car impounded or your children starve. So for better or for worse, in bad times when people need money, they have to sell something. And that includes stocks. Not because they want to, not because they necessarily think it's a good idea, but they just need to. If I have to choose between selling a 52-week lows or, having my, electricity go out, I'm obviously going to take a fat paper loss, because I want to actually be able to see at night in my apartment and be able to cook food, etc. It's like the old adage, crisis and opportunity. Buy when there's blood in the streets. The amount of reasons people have for needing money, to need to raise cash for their everyday lives, or to pay their mortgage or pay their car, or they lost their job or whatever, that is going up. It's a bull market in problems. And most problems require money. And you can get money by liquidating assets. Selling your coins, selling your silverware, selling shares. Again, not because you want to, but you need to. So those are when the best bargains are made, when people who don't want to sell need to sell. And if it starts out from a cheap price and you need money right now, when there's few buyers in the market, you will see these absolute, waterfall declines. Because there's few bidders and somebody needs to raise money quick. So those are the cases where, like, a stock where nothing has happened, absolutely nothing has happened to value. Value is still the same. Somebody needs to sell shares in one of the lowest liquidity environments we've seen on the TSX V since 2005, I think. Meaning there's never been fewer buyers really out there. So when you need to sell, you can get opportunities that just go absolutely ballistic. Sanyu Gold is a good example. After this spike, in next day, I think it was up 58%. That's not a rational market. That's not an efficient market. Those are probably forced selling, and as soon as that went away, prices went up. So you can have fun looking CEO.ca and biggest losers. I just checked a few out. It's like, okay, Japan Gold, 17% down, highest volume in 3 months. I'm not 100% sure what's going on here, but Japan Gold commenced drilling. I mean, it doesn't sound like there's been a bad news release. Personally, I'm not too keen on the management team in this case, so I probably won't touch Japan Gold. But Barrick Alliance, did Barrick participate here? No, I guess not. But they still have an alliance with Barrick. So it's like, again, when you have this stuff showing up, 3 months highest volumes, and you look around, it's like, did every single company just go drop in value by 20% in a day or something? No. That's probably, might be the same individual or the same fund that is raising cash across the board. If you need to raise $1 million for redemptions in a low liquidity environment, you might need to sell shares of, I don't know how many companies, let's say 10 stocks, and you'll bring down every single stock down, 20%, let's say. If there's ever a time to bottom fish, it's at times when people need to sell and there's no buyers. Because you have no idea what happens afterwards. If this was forced selling, I don't know. I just know Bear Creek went 200% higher in a few weeks. I know Sanyu Gold for a while went up 58% in a day. And again, it's like, I don't know every company here, obviously. I was like, okay, well, Midnight Sun, Barksdale. Well, it's like, yeah, okay, Barksdale, yeah, it has also had cascade selling. But here it more makes sense because there's actually been negative news. So this you can't, I mean, you should look at the news flow. Because there's no way that every single stock, if 20 stocks go down on big volume the same day, that is not company specific. That is redemption selling or somebody who needs to raise money quick. Those are some of the greatest opportunities. So it's like, if all else equal, you see a flush in prices, that could be an opportunity. Obviously, again, it's like, yeah, if you look at Barksdale, well, there's actually been headwinds for them. There's some legal battle going on, which might screw up the timeline to drill, I guess. Well, that's that's kind of material. That could be a problem. So here you actually have some news to go with the waterfall decline. So that's not the same thing as some company that's only put up good news and still had a waterfall decline. Silver 1, a pretty big volume. And it's like, yeah, okay, you have this volume. Is it the highest in? No, okay, it's not. No, it's not super high, but still, it's like 10% minus. And at a time when you have other stocks spiking in selling volume. Might be the same fund, might be the same individual. Here you had this was probably a liquidity event. I think I remember Quinton talking about the guy or the group or whatever that vended the project to Red Pine. Because if I remember correctly, this was pretty good news. This was on what's that, like February 21st. Well, appointment of CFO, I guess it's this. Red Pine extends gold mineralization within below Jubilee Shear. So, I mean, this headline hole is obviously super. 5 grams per ton over 27 meters. But it looks like that, somebody was waiting for big volume to be able to sell. Because you can see the volume here. It's like, yeah, not enough. But all of a sudden it spiked to, what is that, 2 million and 10 million. So obviously the news doesn't warrant that kind of volume, or especially that it became a decline, a drop in price. But somebody needed or wanted to raise a lot of money. So 13 million or so shares got traded in like 2 days on pretty good news. And that absolutely killed the momentum. And who knows, maybe that buyer is not finished yet. That might be the reason why there's been kind of a lid. I talked to someone about line 1 who suggested that it's been a fund that's been raising money or liquidating the position, whatever. So there might be one entity, for whatever reason, that has been selling shares, and that one seller might have dropped down, because I can't really justify the price of Lion 1. I think it's too cheap. Why is it too cheap? Well, if there's almost no buyers in the sector and you have a big seller, that's all you need to know. It probably doesn't even matter what the actual news is. Until this seller is over, there might be a lid on this stock. The thing is, of course, that when the lids go away, when the sellers are out, when they have bombed this sector or a specific junior, absolutely bombed it to absolutely ridiculous prices, and one day they let's say they are the only seller. Let's say they explain all the selling down here. Nobody else is willing to sell here. When that buyer goes away, there will be nobody left that will want to sell at a price, let's say, lower than this. So what happened in Bear Creek, for example? Yeah, like I said, 200% in, I don't know, 2 months, perhaps 1.5 months. So that's the stuff you can see when there's been one seller, let's say. Nobody else is joining them almost. One big seller. Let's say 99% of shareholders think it was already too cheap here. But the 1%, the 1 in 100th shareholder who needs to sell or wants to sell for a specific reason, he will keep bringing the ask down. And when that seller is gone, poof, might be clear skies for the ask up to $1, which kind of what happened. So think about that. And most important thing is that it might look like a nothing burger, that it's gone down so much already, it's down 20% more. It's like, well, I'm already sitting at a paper loss, I don't want to buy anymore, even though you're kind of convinced that the price is ridiculous. Again, just see how the potential future returns change, going from shitty to shittier. Hundreds of percent, years worth of returns. Years worth of returns. Many years worth of returns can present themselves. Well, opportunities which could add returns, which you would be happy to get in 3 years. You could get those opportunities, such extreme opportunities, just from one single seller that needs to raise money at lows when nobody's out there when there's not enough buyers out there. Who knows, maybe yesterday or whatever, let's say a fund liquidated one of these positions. Maybe they liquidated across 10 positions. Maybe the stocks of those 10 companies on average went down 10%. Maybe the future expected returns in one day in those 10 stocks got ramped up by the, let's say, expected future returns over the next 2 years went up by 60% from one single seller selling 10 stocks. That they were already cheap to begin with, they brought them down 10% cheaper. Maybe anyone who picked those shares up at 10% cheaper are gonna earn an extra 50% over the next 2 years, just on those positions alone, thanks to one seller. Like I always say at lows, this is not the time to be lazy or scared or indecisive. You have no idea what a 10% drop in price can mean for the future for the future returns. Take this, okay, yeah, let's say this drop here, it's like, it's already such a shitty performance, gone from here to here. It's like, it's down 50% more. It's like, it doesn't matter, I'm down whatever. It's like, yeah, okay, I'm down, I was down 95. Ooh, big difference if it's down to 96. I mean, it's like a rounding error. But if you actually look at what kind of buying opportunity presents itself, so to the next high from this level, that's 539, and even though this looks like a blip, so from 539 or whatever, the future returns might have been jacked up by 100%. And of course, I mean, the higher it goes afterwards, I mean, if it was up here, then the difference, if it wouldn't reach, if sentiment would have gone really bonanza or bonkers and silver would have hit 50 or whatever, maybe this low here would be a 2,200% return instead of a 1,900% return. So that's like 300%, well, more, 400% extra return. 400% is many years worth of returns. You would be happy to get 400% if it took 5 years easy, just from one panic seller. Imagine you put in 5% dry powder here instead of here, and it actually went up here, and silver went $50. That position would go up 23 times, 24 times. And if that's $1,000 you invested, that's $4,000 more. More, not total, more. Just from this little dip here. Future returns go absolutely ballistic at extremes. So I'm gonna be looking out. I mean, I'm not gonna be go too hog wild in case or a story I don't know too much about just because I saw it get cheap. But I have no doubt that, again, you can make money in a lot of ways. If I built a portfolio that was only made for, let's say, total bargain shopping portfolio, and I only looked for, and I could only include, actually I should do a portfolio like that perhaps as a test. But anyway, so if I only at the time like this looked around, okay, what stock has crashed 20% on heavy volume with no bad news out, and if I just picked up stocks like that, again, I think I'm gonna make a lot of money, because that would be playing this the beta angle without knowing too much about the companies. But I'm not gonna, again, I'm not gonna go hog wild. I mean, the position I picked up in Sanya, I mean, it's negligible really, but it's still too good to pass up. That's what I thought. And maybe there are some other stuff here that's like, yeah, I think Montage is cheap, but yeah, main thing is like, don't overdo anything. It's like I will rather miss a bunch of flash crash opportunities in cases where I'm not that convinced about I might not think it's a high quality stock, because like I'm gonna make money on my high conviction picks or my high conviction portfolio. That I'm pretty sure about. It's just that there are opportunities at times like this when you have forced selling, that a stock might have been okay buy here, and like a few days later it's like, yeah, it's a no-brainer simply because somebody took down the price too much from forced selling. So it's like there's always something. Keep your eyes out or up or whatever. And it's like believe me, it's time at times like this. This is when the big money is made. The money is not made here. The big money is not made in bull markets. The big money is made in bear markets. Because that's the highest change. That's the highest delta, going from an extreme to another, or opposite as well. The big money, the big returns, the returns that really can affect your portfolio are created. They are birthed. They are seeded in the bear markets. Buys will never impact your portfolio in a positive way more than they do at extreme lows. If I sold one of these lows, if I had sold this low, or if I had bought this low, sold this low, or if I had bought this low and sold this low, for example, my portfolio would look completely different. If I just bought this one and held this one, instead of buying this and buying this, or I just held here and held here, or sold here but bought here. There's a bunch of combinations you can do. Obviously, you should be buying extremes every single time. Otherwise, it's going to have huge effects. Like if you hold here and buy here, that's the, I was going to say the worst. Pretty much. Well, sell and buying here is even worse. But you get my point. It's like every single decision we make adds up. And now, until we're up here, I'm, total exposure, 100% exposed. If I'm not 100% exposed at extremes like this, I don't know what would I be doing. With that said, physical, gold and silver, etc., and cash, that's your actual insurance, economic insurance. The money we put in the market, that's for wealth creation. That's not wealth preservation necessarily. So we are taking risks here a gold coin doesn't have risk, but it doesn't create more gold, but it can revalue a lot higher. So I simply think that personally, I believe that I will make a immense amount of money in the coming years in miners, and I do think I need actually to buy more physical as well, because if you have a okay stack of, let's say, physical gold and silver, you're gonna be better off than 95% of people, probably, even if your portfolio went to zero. But if the portfolio does what, if the world doesn't end, we're gonna be not only have a good situation from our gold and silver physical, we might make a fortune in miners as well. Anyway, a big rant, long rant. Thanks for listening. If I mention any companies and assume I'm biased, well, I did mention companies, so I assume I'm biased. And some might be banner sponsors. I'm not sure if I mentioned some. Yeah, Line 1. But otherwise, consider me biased. I'm just airing ideas here, how I think about the sector. But this is this slide is, as always, the most important one, because it makes it. I mean, there should be absolutely no confusion. You should not be. Next week you're thinking about, now I think, I'm bullish today, next week, now I'm probably gonna sell. We're not even near any sell conditions. We're not even close. We might be a year or two away from sell conditions in my book. Anyway, thanks for listening. Bye.